What's going on, guys? Welcome back to the show. In today's episode, I sit down with syndication and fund attorney Tilden Moschetti. Tilden is the managing attorney of Moschetti Law Group, and he has helped hundreds of syndicators and fund managers navigate the complex world of securities law and raising capital. But what makes Tilden truly unique is that he's not just an attorney, he's actually somebody who's walked the talk as a syndicator himself. So being able to speak from both sides of experience, extremely valuable. And you're going to see that in our conversation today. We broke down the difference between a syndication, a fund, when you should use one, which is better or not, what the difference between a 506B or C, a Reg A, a Reg CF. There's a lot of things that go into these, and you really just want to go into it eyes wide open. So we talked about what documents you really need in order to legally raise capital. What do you need to do to protect yourself as a sponsor or as a limited partner if a deal doesn't go as planned? And a lot of the common mistakes that so many syndicators have made recently that have got them into legal hot water. We literally go over basically the whole process from start to finish and what you can expect and how this applies to your own unique goals and situations. So if you are somebody that's launching your first raise or you're managing a grower investor base, Tilden breaks down the complexities of this in plain English and shares practical strategies to keep your deals compliant and your investors confident in you so that way you can keep growing your business, your investments successfully. So grab your notebook because this episode is packed with very tactical, strategic advice and insights. I think you're going to get some major value out of it. Let's dive into today's episode with Tilden Moschetti. Tilden Moschetti, thanks for being on the show today.
Absolutely. Nice to meet you and great to be here.
So for those that are new to syndications and funds, what's the difference between the two?
Most people think of them as two separate kind of topics. A lot of that's a very early call that I get and a question I get. Really, we're talking about the same thing. So, just kind of on top of this layer is what's a security. So, a security is anything that where there's going to be a passive interest and that person is expecting to earn money from the work of a third, right? And so most people think of a syndication as there being one asset and a fund there being more than one asset. So that's the general breakdown that people do.
And when do you think, for those that are either a syndicator or maybe they have a deal or an opportunity that they are looking to syndicate versus them considering multiple opportunities, when would an investor use, in your opinion, a syndication versus a fund model? Which applies and where best from your experience?
So typically it depends on the number of assets we're talking about, right? If there's one
Yeah.
asset versus multiple assets. The other kind of considerations that we go or that we think about is what's the lifeline look of this project. So, are we going to be having assets come and go? Are we going to be having investors come and go? That's all going to change on whether or not we're going to kind of call it a syndication or a fund. From a legal distinction point of view, there really isn't. So it's really more in the matter of how we set it up and structure it and ultimately convey that structure to the investor so that we can tell the right story. Because if they're getting a fund, that's one set of things that the investors are thinking about, right? Hey, I'm gonna take some money and I'm gonna go buy some stuff. Or versus a syndication is more, okay, give me some money and I'm going to go buy this thing, this 123 Main Street or this other asset. And so the 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 difference in the paperwork really is more how do we tell the right story to the investors so that they can kind of understand it as quickly as possible.
Yeah, I always kind of tell people, depending on, what your short-term and long-term goals are yourself, and what you think is best aligned with the capital that you're trying to bring into the opportunity. Syndication, like you said, being more of a one-off opportunity. Here's exactly what we're buying, and here's the structure. And obviously, the fund being more of we're pooling these funds, and this is our investment thesis that we're going to go out and try and buy these assets or opportunities and spread out those funds across multiple opportunities over time. Now, talk about the different vehicles for a syndication or a fund model, and kind of the different, I guess, offering structures that investors and or syndicators, LPs, investors should be thinking about when we're talking about a 506c or a Reg D, or what are the differences that are out there, and what should people be thinking about when they're analyzing which path to go down?
Sure. So there's a lot of different exemptions that there are. So we've got Regulation D or 506B and 506C are there. That's the biggest majority. So probably 95, 90%, something like that, number of private offerings fall under Regulation D. The other 10% are split up between Regulation A, Regulation CF, and then there's some other special purpose things that occasionally happen that probably a regular investor doesn't get exposed to.
So
But under,
I
well,
was
go
going to
ahead.
just say, explain those a little bit more of, the with 90% of those, why is that kind of the preferred structure? And, for a Reg A being more of kind of an IPO, looking to go public offering, right? So maybe just explain and tease those out a little bit to give a little more color or context of those vehicles.
Yeah, absolutely. So Regulation A you can think of as kind of a mini IPO, like you said. Um, it is uh, it is overseen by the SEC. So it's not the same thing as going public, really, but it's kind of close because a bunch of paperwork is prepared, audited financials are prepared, they're submitted to the SEC. There's a comment period back and forth until eventually it's basically approved by the SEC, and then it's now a real regulation. So the reason people don't choose Reg A is it's really expensive and it takes a long time. Not as expensive or as long a time as truly going public, but you're looking at a absolute minimum of 6 months of preparing for this thing, and costs probably over $100,000 to get it ready.
And who would
And
you
that's
say
just
that's best suited for?
there are occasionally the fund structure is such that it actually fits really well. But most of the people who are doing Regulation A, it really is like a business opportunity that probably is going to be going public in the fairly near future, and wants to kind of do a pre-seed round where they're still getting money and still being able to advertise and pull money in, but not go through the full-on process of going public. The other option is Regulation CF. Regulation CF is great in idea, but it doesn't work so great in practice. The biggest problem with Regulation CF is, well, A, we have a cap on how much money we can raise. But more importantly than that, it's that everything needs to take place through what's called a registered portal. So that portal needs to be registered with FINRA, and it needs to be a third party. So it can't be the syndicator themselves putting it out there. They need to hire a company to do that. The fees of that those registered portals are oftentimes very high. And so that can just absolutely decimate returns that the investors ultimately get.
Right.
And so it's obviously very hard to market, hey, come invest in my real estate portfolio. We're going to get you a 1% return. That's not going to be very appealing. So Regulation CF for those generally not used. For a lot of like startup businesses, though, it can work out great
Okay.
because there's not a huge volume of transactions going in and out. So the work that that the portal needs to do isn't very big, and you can market it readily. So generally, that'll be like a startup business, like really, really early startup. Regulation D is really my bailiwick. So Regulation D lets us raise an unlimited number of dollars from an unlimited number of accredited investors, and the choice of either being able to take non-accredited investors or we can advertise. And that decision basically comes from, where are the investors coming from? Are they people that you already know? If they are, you're probably going to choose not to advertise, have some non-accredited investors, and a slightly easier onboarding process. If you don't know all your investors, you're probably going to choose 506C. You can advertise, but we got to make sure everybody's accredited.
Yes. Now, talking a little bit more, which you kind of alluded to a little bit, talking just about setting the proper expectation around what does this legal process look like to, launch a syndication or a fund? What are the key documents needed? What does it usually cost to set some of these things up? How long does it take? Just so people can kind of wrap their heads around which path they may go down and what the differences might look like.
Yeah. So under Regulation D, there's really three documents that are critical that we prepare aside from notifying the SEC. First and probably most famous is the Private Placement Memorandum, or PPM. That's a document that describes the terms, it describes the risks, it describes conflicts of interest. I like to think of it, and I refer to it as, when you go and open up a checking account at the bank and they hand you this big book that you don't read, most of the time that's the PPM. Now, I'm
Right.
not saying you shouldn't read it, because you should, but a lot of investors just don't read them. But it really is what walks you through, make sure that it's very clear what the investment is and what the downside chances are that that something's going to go. The second document is an operating agreement. That's really the document that sets the rules for the investment. So the PPM is the document the syndicator can say, "I told you so." The operating agreement is, "This is why we did it that." It tells exactly how distributions are going to be made, if there's any voting rights, all those things are contained in the operating agreement. The third document that's there is the subscription agreement. And that is the document that the investor signs saying, "Hey, in exchange for $100,000, I'm getting this portion of the investment." So it basically binds that investor to the investment and to the operating agreement. Aside from that, it's documents that get filed with the SEC to make sure that the SEC is in notice and that we're safely parked in the safe harbor of Regulation D. And then we also need to notify the states where investors are coming from, almost always. So those are kind of the key documents that exist. Turnaround time varies between attorney to attorney. My turnaround time is 2 weeks, and costs vary from somewhere around well, generally you're going to pay more than $10,000 for an offering, and up to quite a bit. Some big firms charge. I mean, I've heard of big firms charging $100,000, which is too much. So if you get a quote for that, you're paying way too much. But there is generally, you're looking on somewhere between $10,000 and $30,000.
Yeah, that sounds about right from my experience, and obviously what I think is probably relatively industry standard, depending on the complexity and the structure of the deal. Now, talking about SEC compliance, being that once you decide to go down this path, you are under the microscope. There's rules, regulations, guardrails that obviously you have to play within and do within compliance. So, talk about the SEC from a macro perspective around how they oversee and regulate and why.
Sure. So the SEC's job is to make sure fraud doesn't appear, right? So we don't want some unscrupulous person taking grandma's last $5. And so its main purpose for existing is really that. Now, the way the SEC actually monitors and kind of controls Regulation D offerings is actually driven marketplace wise. So, what will happen is we'll lodge our paperwork with the SEC. The SEC doesn't review it. They don't look at it, and it's just there on the radar. Now, this isn't true of all the states. We'll talk about that in a minute. But the SEC doesn't look at things really much at all. When they get notified and when the SEC gets involved is when you have an investor who has a major concern and they file a lawsuit. The first thing that's going to happen is the plaintiff's attorney is going to notify the SEC that there's a complaint, and they're going to go into great description on why this is invalid and violated the securities rules. Once that happens, then the SEC starts looking at it in greater detail because they want to see if fraud occurred from their point of view and whether they want to prosecute the case. If they do decide to do that, the plaintiff's attorney is happy as a lark, right? He's going to get his money without doing a lot of work. So it's kind of a slam dunk. SEC is going to step in, win the case for him, and case closed. So uh, it from a marketplace, it does a pretty good job of being able to take the place of the immense scrutiny that would have to go in if the SEC was actually looking at every deal. Because really now we're just rising to, hey, when there really is a problem, we need to know. State regulators fill a similar function, except generally state regulators will watch the notifications a little more closely than the SEC would. So it's not unusual. I will receive maybe no 4 or 5 just like calls or emails from a state from a client regarding a client, and normally it's just a simple question of like, hey, can you send me the cover page from your ppm or something like that. They just want to make sure that whatever their people are investing into aren't getting into some sort of fraudulent activity. And so they will spend more time doing the scrutiny than the SEC. Normally, I've never had a case where it hasn't been very easy to solve with the state regulators. Most of them are just trying to protect their public as well.
Yeah.
They're pretty easy.
Now, I believe there was some recent changes. I forget which law it was that somewhat made it a little bit easier in terms of disclosures. And I'm trying to think were there any recent changes under the SEC around um, syndications?
Not in our world, other than they've opened up accredited investors to include people with securities licenses as to be considered as considered accredited investors, regardless of whether they were.
Got it.
I think
Got it.
ultimately, even if even if the SEC decides to change its rules, the system is actually set up beautifully to self-police very much because we do have, you know, plaintiffs' attorneys who are anxious to work for their clients, for investors who feel like they've been wronged, kind of reinforces a mechanism where even if the SEC says a good example is we had a change in how we consider accredited investors, right? Whether if a private person contributes $200,000 or invests $200,000, we don't need to go through the scrutiny of getting third-party verification that it's there. That's the SEC's work. I actually wrote the SEC about it because they made the wrong decision.
Mm,
They should not have written that because there are a bunch of non-accredited investors who have $201,000 in their IRA, and that's their last penny. And they could go into a deal, invest in something with somebody that they don't know under 506C, be considered an accredited investor because they're investing $200,000 or more. They didn't have the scrutiny to do it. And although the SEC said it's not going to prosecute, it would take nothing in order for a plaintiff's attorney to easily prove their case that you knew that this was a non-accredited investor and it was their last dollar.
yeah.
And now the whole house of cards that they built comes tumbling down. So I think it's a terrible rule, a terrible no action letter that they wrote. But
Yeah.
that's an example of this self policing that goes on, where even if the SEC decides, okay, XYZ is okay, doesn't mean that it's actually going to be okay when it comes to practice,
Yeah.
right? Because we've got people who may want to make claims, and my job is to not only make sure that we comply with securities rules, but also make sure we don't that one of my clients doesn't fall victim to something where, well, now this investor, even though they were treated very fairly, wants to break everything and things like that. So
Now, talk a little bit about accredited investors and what your general opinion is around only offering to accredited investors versus the difference between offering to non-accredited investors and some of the pros and cons of each side.
sure. Accredited investors, just for quick definition, is anybody with a net wealth of over $1 million. This doesn't include the equity in the family home, or they make over $200,000 for the last 2 years and counting the current year, or 300,000 if they're married. The choice, if you're doing a 506c offering, it's going to go to accredited investors. Now we actually don't care if non-accredited investors see this. It gets start conversations and get them ultimately as potential investors when you do a 506b offering later down the road, or if you do, or they may improve their wealth, right? And so can become an investor in the future. So there's not a problem with them seeing the any sort of advertising, but generally because we are paying per click, or we're paying to interface really with accredited investors in 506c, then generally we're trying to preserve the money that we're spending on advertising to be just those people who are most likely. In terms of, I think that it helps syndicators to realize that the rules there are to protect investors, and when yeah, it's a very different situation from somebody investing $50,000 and they've got 100 million in the bank, to they're investing $50,000 and that's it. And they don't have very much of an income. They're two very different scenarios. So non-accredited investors are oftentimes more anxious about their investment. They're more concerned. They'll call more. They'll ask more questions. They'll be freaked out a lot, and rightly so, right? Because the money is just proportionately means a lot more to them
Yeah.
than it
Yeah.
will to somebody who's accredited. So those kind of considerations go into it when you're structuring a deal. Do I want to take people, investors who they don't have a lot of money, but we think we have a really good product that's going to make a lot of money for them? That's great. But certainly we don't want to be thinking, well, this is really, really, this really may not happen. The risks are super high. We may want to just steer towards accredited investors anyway, just because they can bear the brunt of the risk more. And we don't have these kind of concerns where if things start going bad, this isn't their last dollar.
Yeah.
We
Yeah.
obviously always want it to go good, but it doesn't always go good, right?
Well, let's talk about that because obviously, uh, and before I ask this question, would you say after COVID, there was an uptick in new syndicators coming into the space?
Absolutely. Yeah. I mean, I think there's a huge wave of people moving away from public securities into private securities. And I think that's kind of two reasons. I think the one reason is because people have just become jaded with, especially, before then we had Enron and we had things where, boy, we certainly can't trust the public companies anymore anyway. Um, uh, but we also have, how I like to put it is, I can't, if I buy Apple stock, I cannot call Tim Cook on the phone and ask him why he chose to release
Right.
the iPhone late. It's never going to happen. He's not going to take my call. So, but I can always call the syndicator, the sponsor of this deal, and be like, hey, I'm kind of concerned about why you chose to do this. Can you explain it to me and tell me what the thought process is? And certainly all of my clients, and I think the vast majority of syndicators will take those calls and have a good conversation. Certainly the ones who want to stay in the business
Right.
will take those calls and have a good dialogue about it with their investors. Um, and that trust level, I think, is why alternative investments like this are awesome and are going to just keep getting bigger and bigger and better.
Yeah. Yeah. I mean, as an alternative, to the stock market and, many of the, I think, vehicles that historically many have allocated capital to, this has become a more accessible and more, I guess, active vehicle that people are now starting to explore. And that's good, but it also comes with sometimes bad. And we've seen, in light of the headwinds, kind of post Fed pivot, late 22, and interest rates, jumping up, a lot of the, rosy pro formas that syndicators were offering, thinking that, rents weren't going to plateau or certain headwinds necessarily weren't going to hit. They did. And I'm just curious from your perspective, seeing so many different syndicators or, individuals setting up funds come through your doors, what are the top mistakes you see sponsors making when structuring or raising capital that could be avoided with a little bit more awareness?
I think there's two big categories. So the first is, well, this we don't really need to do a PPM and we don't really need to do this isn't we're gonna just call it a joint venture mistake, which is a huge mistake, right? It opens the person up to kind of instant liability. So if I set something up as a joint venture and ultimately it's decided it's a security, I've committed a securities violation, which probably isn't going to rise to a criminal level. But what it will do is destroy the investment. So when something is found to be a security and I didn't do it properly, all the money is due back to the investors instantly, like not an hour from now, but like now, all that money, and there's probably opportunity cost, especially if it's a real estate syndication. There's no way you're going to get the money out that quickly. And so there's going to be this huge amount of damage that's done. Properties have to get sold at the wrong time. Everything just blows up. So that's a whole set of problems right there. The second set of problems, and I don't see this very much. I certainly don't see it with my clients. I don't think I don't see it in general super common, but I think we've learned a lot of lessons as the rates changed and things like that about, being conservatively, right conservative, and make sure that all underwriting is just very, very good and likely. So, saying, I mean, the incidents that happened in Texas are a good example. I mean, they bought a whole bunch of apartment buildings in the middle of, I think it was in San Antonio, where there were a ton of other apartment buildings, all workforce housing, and they thought they were going to raise rents to luxury rates. Well, that's not where luxury people go. There is no way they were going to double rents, no matter what they did to them when they actually didn't do anything to the buildings. And shame on the banks, even who lent them money, because
Right.
there's nobody that thing was going to make money. So it's not surprising that it went bad, but it's also not, from my looking at the deals, because I pulled as many of the deals that they owned to like kind of see what happened. I didn't see anything wrong legally that the sponsor did. I just saw really just they didn't know really how well to underwrite this thing,
Yeah.
and they just failed completely at that. And they warned their investors enough in a PPM to get away with it, in my opinion. But they really should have been super conservative. They probably wouldn't have found investors though, if they had underwritten it the way I underwrite deals. So,
Right, right. Well, and talk a little bit about how can, there's controllables in these things, and then obviously there's a lot of things that are outside of a sponsor's control. But talking about the things that are in the control of the sponsor, how can a sponsor protect themselves legally if a deal doesn't perform as projected? Or, are there any particular clauses that you recommend adding to protect sponsors and down markets or when things don't go according to plan? What are your perspectives around that?
yeah. So, I mean, certainly in the documents, there's plenty of, we identify risks, and my job is really to make sure that I've conveyed as much of the reasonable risks that are likely to happen. Changes of interest rates, certainly likely to happen.
Yeah.
Moon falling into the earth and there being a tsunami, not very likely. I don't write a risk for it. So the things that are likely to happen, or more than a 5% chance, probably need to be written in there and described in a way that kind of explains why it's a risk, and what bad can happen from it. The second set is really what I tell people all the time. So you can have a deal that falls apart, and I've seen deals fall apart and seen what looked like a great deal go forward and just kind of crater, and it's a terrible situation. But the sponsors who are on the phone with their investor and explaining things and are communicating a lot never have a lawsuit. They just don't. They have investors who are kind of upset because
Right.
they've lost money, but I've never, in my experience, seen a lawsuit where the guy's been on the phone. Occasionally, I'll talk to investors who, a deal goes bad. I don't represent investors. I only represent sponsors. But sometimes I take those calls because I kind of want to know what's going on in the world, and then I can typically like point them in the right direction of who to hire. Every single time it's, I haven't heard from my sponsor in 6 months.
So
I
true.
haven't heard from them in a year. They never send me an email of even a status update. Well, geez, that could be prevented so easily. Just talk to these people. I mean, I've had deals that had some bad situations start to happen. Fortunately, nothing bad did. Um, but I mean, first thing was, got to tell investors now. Like, this may not happen, but we got to tell them like now, so
Right.
that way they, and they were worried about it because I was worried about it too. But those things just never, they didn't happen. But those investors were never going to come after me, and they chose to invest with me again because they know we're ready to communicate.
Right.
And so
I would
that's the most important thing.
I've been in a handful of different business mastermind groups, and you hit the nail on the head. There's a lot of things that are out of the control of the sponsor sometimes, right? And while we, always hope for the best, you should also be, preparing for the worst. And when the worst happens, the ones who went silent and dark were the ones who ended up in a lawsuit. And the ones who were going, "Hey, I know you don't want to hear this, but here's what's going on. Here's what we're doing. Here's how we're fighting tooth and nail, all hands on deck to protect all our investors' capital. Here's what our
Mhm.
like." Okay, I don't like hearing that. I'm not happy about the situation that we're in, but I can respect the fact that you still got both hands on the steering wheel and you're trying to navigate a challenging,
Yeah,
time right now
exactly.
versus those that are just, you can't get a hold of them. They're not emailing, they're not responding to emails. That's a recipe for getting yourself into a lawsuit.
And I get it. I've been in the situation, and my first desire was to hide, right? That I would love to hide, or if you screw up, I'd love to not say, "Hey, there's a problem here." That would
Right.
be great.
Yeah.
But man, it's going to get you in trouble at the end. So
100%. Accountability is, I think, the number one thing that I have found most investors want. Yes, everybody wants to win, but they just want to know that the capital that they have trusted to somebody else has somebody who's accountable to it. And when you stop communicating, that's the number one red flag of my money's gone. I'm assuming my
and
money's gone at this
even
point.
if it's good, even if
Yeah.
all things are good and they haven't heard, I mean, people go really quick to that guy stole my money. I mean,
Yeah.
that's where their mind goes really fast. So, uh, that can be prevented very simply by
Yeah.
not taking money, but also, communicating, hey, this is what's going on. This is where everything's at.
And just because real quick, we're on the topic of kind of liability, right? For the sponsor and, what gets them into trouble and not. What would you say? How should sponsors be thinking about their own personal liability, when raising funds from a group of people? The second you take capital from somebody else, I always say, you now have a job working for those dollars, right? You have some responsibility, some accountability, and some legal liability that you need to be aware of. So, what should they be thinking about when it comes to liability? And how should sponsors be thinking about structuring deals to at least mitigate their risk to maybe that opportunity or protect themselves in the process?
Yeah, well, certainly we need to build legal framework to protect them, you know, to segregate it out. So having an LLC that is the management entity that shields that, protects the gives that asset protection to the sponsor, super important. But I think whenever a decision is made, even though sometimes in documents we may say, hey, we don't have any fiduciary duties, you do still.
Yep.
Whether either, even if I write in an operating agreement that there's no fiduciary duty, there really is. And the first thought should always just be, hey, if I was an investor, what should happen here? So, simple accounting rules, no taking money out of the general fund and putting it into your personal bank account. No, no paying yourself first unless it says in the operating
Right.
agreement and everybody knows you get paid first, which is rare. Um, things like that are important. I like to I will oftentimes for my clients like walk through how I do different transactions in the entities, like for paying management fees or paying these different kind of fees out. I'll give them what the entry needs to say in the ledger because I want it. I've never been audited by a client, but I want it so good that if ever I got audited, it would be like, here's that, here's that, here's that, here's that, so
Right.
there's never there's not even the question of, hey, what's this line item? There would never be something that would be off, but I don't want them having to even ask,
Yeah.
right? I want them to be like, oh, okay, well, looks all good to me.
Yeah. Yeah. Well, and talk about what can LPs ask for legally from their sponsors, right? Because sometimes
Yeah.
sponsors, hey, I want to
A
see the
lot.
books. Can they ask for the books? Well, you know what? Sometimes you got those nosy LPs that want to be involved at a really high level, or maybe they have some concerns. So, talk a little bit about how a sponsor can keep their house in order, knowing that an LP has the right to request or ask for certain things or not.
Yeah. So, I mean, it tends to be your engineers and accountants that ask for the most detail,
Always.
and you should always keep them in mind. And it's not a bad idea to make sure you always have some in your investor base to keep you on it.
Yep.
Um, but uh, yes, they probably always can ask for a full detailed accounting. My general practice has always been I give P&Ls every quarter, and then I give a full the P&L, the balance sheet, and this cash flow statement once a year, along with all the tax filings, along with the quarterly description about what's going on and things like that. That I still have had occasional, typically engineers or accountants that ask for the general ledger, and will ask for detail about a couple lines just because they, want to spot check it. And I there are some states where it's not going to be where you don't aren't going to need to give that kind of detail, but that would never be my advice. My advice is always give it. Because if you act like you have nothing to hide, right? Then everybody will know that you've got
Feels more
nothing
at
to hide.
ease.
So there's no concern. If you're trying to hide something, then people just get suspicious. And ultimately, it's their money. So they they should be able to know. I mean, I think morally it makes sense to just think of it as, well, their money. They should be able to know as much detail as they want to know. I don't want to give them it all up front because, man, it can be a lot. And it's a lot of work when you're getting too much, when you have too much accounting detail and you have to, spend all your time answering questions about how many nails you bought.
Right. There's that
Um,
balance between, give a mouse a cookie, right? Versus also wanting to have that level of trust and transparency that you're building with your LPs, knowing that, at least in my opinion, my goal isn't to do just one investment with somebody. I want to win with them and
yeah,
I want to build trust
exactly.
with them. I want to build reputation and show them in terms of how I operate that this is what you can expect. This is our standard and we deliver. And therefore, when we return your capital and what, you were hoping for, that you come back in on another deal and another deal and another deal, right?
That's
And that's
exactly right.
that's
Every
that's what you have to
investor,
balance when you're thinking about some of those things.
every investor should be looked at as they're a future investor for your next deal,
100%.
uh, and treated that way. And there are going to be, every deal has an investor or two that you don't like and you're not going to want in the next deal.
Hmm.
But inevitably, they're friends with somebody else in the deal. I
Yeah.
mean, I've found so I always treat them well, even though I know I'm never going to bring them the next deal because they're talking to their friend who also is in the deal, and I do like him, so I want him to stay.
Yeah.
Uh,
Can
so
you
just
shed a little bit of light around, many people that like to do a co-GP or, hey, if you can raise X amount of dollars for me, I'll cut you in on the JV and what some of those structures look like. How do you advise on that to somebody that may be looking at an opportunity in a structure like that?
uh, there are a whole bunch of rules. In general, those things are probably not going to really pass a lot of scrutiny. Um, but at the end of the day, deals have to get done. So this is not me wearing my lawyer hat, by the way. This is me wearing a practitioner's hat of syndicating. So there are occasionally things that need to take place in order to just make sure you raised enough cash. And so sometimes you have to incent people and get cash in. So with my clients, my advice is normally talk with me about it so we can shape it in a way that's as likely as possible to withstand as much scrutiny as possible. My job there is to make sure you know where the line is. I can't let I can't let a sponsor like go way over the line. But I can keep them on the good side as much as possible. Right. Uh, so like with deals about, hey, yeah, well, I'll give you some of this deal and cut you in. Okay, but let's really make sure that you've got a job that's ongoing in the sponsor organization, that's going to survive longer than just this fundraise period, and have something kind of real, that at least it's probably okay by the true letter of it, if not by the spirit of it.
Yeah.
Uh,
Now, what should sponsors be asking an attorney like yourself or another attorney that they may be considering before hiring them to ensure that they are the right fit for them, right? Is one size
yeah,
fits all, or is there some differences that
no.
people should be understanding when going in and hiring an attorney to accomplish what they are looking for on a syndication or a fund?
I think, well, yeah, a large part of it, I think, is probably personality. I have my sort of stylistic approach of, this who I am here is who I am as a lawyer. Right. So, but there are other attorneys that have a much more formal presence, and that works better for some people than for others. And so that's a huge part of it, because you're going to be spending the syndicator needs to trust their attorney that they're getting that kind of advice.
Yeah.
I think it's very helpful if, I bring to it boots on the ground experience doing my own deals. I don't think there's very, very many of us that those lawyers who have done our own deals. Uh, and, it makes it hard to understand what the sponsor's deal is going to be when they're sitting across trying to pitch an investment. They need to some of that framework that we go in is kind of for example, I have clients who will ask me, well, I'm getting this kind of question a lot, and so fortunately I've gotten those questions before, and I can say, okay, this is how I've dealt with it. Right.
Yeah.
So
Yeah.
this is how I've explained it, and I'll give them the pitch about what it is. I think that's helpful, versus just some sort of formal textbook answer. So I think experience in that world is possible, and certainly like experience working in syndication in general is important. But really, and then just kind of making sure that I think our delivery schedules are all they're similar in some respects and not similar in others. Like I would much rather have a conversation on the phone with a client about an issue they're having than you have to respond in an email, right?
Yeah.
If you're the kind of person that wants it, well, I need to have it just in the email. I don't ever want to talk on the phone. I can do that, but there might be a better choice.
Sure.
Um, but I feel like I can touch on the nuances better by talking on the phone.
So to recap, somebody wants to set up a syndication from a 30,000-foot view. What would be kind of the main stepping stones that they can expect to go through and should prepare and plan for?
Yeah, so they're always looking for investors. They're always looking for deals, right? So once that starts coming together of like, okay, well, I think these are going to be my main go-to people on investing, or how I'm going to find investors, and this is the kind of deal that I'm going into. That's generally the time when I get brought in. And then we start putting a structure into place. Uh, the deal goes the way every deal goes, right? So the transaction works just like any other, if it's a real estate
Right.
transaction, it's just like every other real estate transaction. It's just where we're getting our money from now has this other stuff that, and so we need to make sure that the timelines are aligned there. Uh, we're still working with investors, talking to investors, making sure they're bringing their money in, they're signing up, making sure that they have the right documents and questions are getting answered, and then ultimately the deal kind of goes that same natural way. Um, I think the most important thing really is, though, start thinking very, very early about what I call the founder's investment theory about, why your deal, why you as a sponsor versus all the other people. Be able to like articulate it and tell it to people, and have a conversation, because that sort of level of confidence that you get from that is what's going to make investors want to go with you versus, hey, I just saw this great deal on LoopNet, and I thought I don't have any money, so I thought I'd use your money. That's a terrible pitch. So, um, versus, hey, I've been working in the multifamily world for 10 years. I know this area super well, and I'm going to find properties that are right here because I know from my past experience that I can 2x their returns in 2 years or whatever. That becomes, oh, okay, that's worth talking about investing in.
Yeah.
So think about that stuff early is helpful.
Now, for those that may want to take those next steps in setting up a syndication or a fund, they like what they hear today, they want to engage with you. Where's the best place for them to reach you?
So my website's probably the best, moschettilaw.com. You'll probably link to it. And then also I have a bunch of videos on YouTube that kind of walk through a lot of the technical questions that a lot of people have. There's like 150 videos there
Nice.
on all sorts of different things that are just, hey, here's the playbook. So hopefully they're helpful to the world, and I do get clients from it.
We will be
I
sure
think
to link up your website. We'll link up the YouTube. You guys can go and check out. There's a lot of obviously stuff we didn't cover today and nuanced questions and obviously based on your own deal, your goals, your investor goals, the structure that you're looking to achieve and kind of your timeline around things. Obviously having somebody like Tilden on your team is a great way to help make sure that you set it up properly, not only for your investors, but for you, right? As the sponsor and the GP. Tilden, it was a pleasure having you on the show today. Thanks so much for joining us.
Thank you.
Well, that wraps up today's episode. Thank you so much for tuning in. As always, you guys know this show would not be what it is without you, the amazing listener, the support, sharing this out with other people who can gain value from it, taking 60 seconds to leave a review. If you haven't done so already, those things mean the world to us and ultimately help us spread this message out to as many people as we possibly can to help them on their wealth building journey. If you have any particular links or resources that you're trying to track down that were mentioned in this interview, be sure to check out this episode at millionairemindcast.com, where you can find access to all that information. And of course, if you haven't checked out the Wise Investor Vault yet, be sure to head over to wiseinvestorvault.com to check out all the tools, all the resources, the checklists, the spreadsheets, the trackers, all kinds of amazing things that can help you on your wealth building journey at the wiseinvestorvault.com. If you haven't connected with me on social media yet, I'm consistently putting out more content, stories, value to help you on your wealth building journey. And one of the best and most exciting things for me on a weekly basis is getting to connect with you guys. Getting your DMs, hearing what things impacted you, what you need help with is a big way that we continue to drive the content for this show. So if we're not connected and following each other on Instagram, on social media at official Matty A, give me a like and a follow. Would love to connect with you there. And of course, don't forget to get on my deals list. If you're an accredited investor, you want to look at more deal flow. You want to see what deals I have access to, what deals I'm raising capital for. This is an exclusive list that I only put out to my accredited investor list, my Millionaire Mindcast family. So text the word deals to 844-447-1555. And with that being said, thank you again so much for supporting the show. Until next week's episode, keep investing in yourself and your wealth on your march to $1 million and beyond. Cheers.